Hi, I'm Mike and this is Mikeonomics. In this episode we're going to have a look at how the Bank of England operates its government bond purchase programme. On the 19th of March, in response to the COVID-19 pandemic, the Bank of England's Monetary Policy Committee voted to increase the Bank of England's holdings of UK government bonds and non-financial grade corporate bonds by 200 billion, and a further increase of 100 billion was announced on the 17th of June. There's quite a bit to break down on this one, as it's slightly more complicated than the CCFF, which was explained in episode 2. Although much of the operation is similar, in particular the process of the Bank of England purchasing assets from commercial banks with newly created central bank reserves. It's probably a good idea to take a step back and explain what monetary policy is and what the Monetary Policy Committee does. I'll do an episode on the general function of the Bank of England, but it would be useful to have a bit of background here for the purpose of understanding how the bond purchases operate. Monetary policy refers to the actions that a nation's central bank takes in relation to interest rates and the expansion and contraction of the money supply. They do this with the aim of controlling economic growth, inflation, consumption and liquidity. I've touched upon the interest rate aspect in episode 1, but I'll quickly mention that if interest rates are low, the cost of borrowing decreases, and therefore businesses and households are encouraged to take on debt, which in turn stimulates spending in the economy. Increasing the money supply works in a very similar way, in that more money flowing through the economy, also known as more liquidity, means that the supply of money increases and therefore the price of money decreases. The price of money has a very specific term, which is of course the interest rate. Ultimately, both of these tools have the same effect of making money more readily available and cheaper to borrow. The Monetary Policy Committee is the department at the Bank of England that decides how to use those tools in the best way possible to achieve its objective of economic stability. The MPC held a special Monetary Policy Committee meeting on the 19th of March in the wake of the economic conditions and voted to cut the bank rate to 0.1% and to increase the Bank of England's holdings of UK government bonds and non-financial grade corporate bonds. We know from our understanding of the MPC that they were doing this with the aim of reducing the cost of borrowing and increasing liquidity in the markets, but they provide a very interesting and important statement about the state of the financial markets at the time, which I'd like to get into. The summary states, over recent days and in common with a number of other advanced economy bond markets, conditions in the UK gilt market have deteriorated as investors have sought shorter dated instruments that are closer substitutes for highly liquid central bank reserves. As a consequence, UK and global financial conditions have tightened. Now those two sentences are telling us that the banks weren't even lending to the UK government. That's how bad financial conditions were at the time. I'll break that down. Conditions in the UK gilt market have deteriorated. The UK gilt market is the market for UK government bonds. The term gilt comes from the phrase gilt-edged security, which is a reflection of the fact that the British government has never failed to make payment on their loans. Investors have sought shorter dated instruments. This means that global investors, mainly banks and financial institutions, didn't want to tie their money up in long-term bonds, which can be up to 50-year loans. They were looking to purchase bonds and other interest-bearing financial assets with short-term expiry dates. These generally have lower yields than long-term, but provide greater liquidity, something that the banks clearly needed to protect themselves against the economic and financial shock being felt around the world. UK and global financial conditions have tightened. Now this is just following on from above, banks weren't lending. Tight economic conditions refer to the lack of willingness or ability of credit providers to provide credit. So throw all that together and you can simply translate it to banks weren't even lending to governments of the most advanced nations in the world, so the Bank of England needed to create the money for them to do so. Now it wasn't just the Bank of England, it was central banks all around the world with a coordinated response, injecting liquidity into the markets, very much in the same way as the Bank of England have done here. In the wake of the 2008 global financial crisis, the Bank of England, under the instruction of the UK Treasury, created the Asset Purchase Facility, a specially created fund to purchase high-quality private sector assets and to provide a framework for the Monetary Policy Committee to use asset purchases for monetary policy purposes. This was initially authorised to make 50 billion of purchases and was introduced in January 2009 with a focus on private sector assets. A couple of weeks later, the Governor of the Bank of England at the time, Mervyn King, wrote to the Chancellor of the Exchequer, Alistair Darling, stating that it might be necessary to use asset purchases in order to meet the 2% target for CPI inflation, and purchases of bank assets would be financed through central bank money or central bank reserves, reasoning that this would act to boost the supply of broad money and credit and increase the liquidity of private sector portfolios. The Governor went on to propose that gilt-edged securities, UK government bonds, be added to the list of eligible assets, and an additional 150 billion was allocated for creation to fund the APF. From this point, the APF took the form that we see it today. The fund has been increased in October 2011 to 275 billion, February 2012 to 325 billion, July 2012 to 375 billion, August 2016 to 445 billion, and we know 17th of March 2020 an additional 200 billion, 17th of June 100 billion, taking the current total to 745 billion of UK government bonds currently held by the APF, paid for by central bank reserves. The APF doesn't purchase the bonds directly from the government in the primary market, it purchases them in the secondary market from banks and other financial institutions. The primary market is when the government bonds initially go on sale from the UK Treasury, and the secondary market is where those who hold the bonds are free to trade them with other investors or traders. The way the APF does this is that it issues a market notice which identifies the type of government bonds that it intends to purchase and when it intends to do so. Banks and financial institutions will respond to the notice by submitting sell price bids. The APF then decides which bids it wants to accept and agrees the transaction with the banks. The Bank of England will then credit the banks and the financial institutions' accounts at the Bank of England with the corresponding amount of central bank reserves that it digitally creates for the purpose of that transaction, much in the same way as I explained with the CCFF in the last episode. This then provides the banks and other lenders with additional reserves that they can use to make additional loans, thus easing the liquidity crisis that was causing the financial markets to crash. The APF has been running since 2009, so some of the bonds it purchased over that time have reached maturity and will have been settled by the UK Treasury. The proceeds from settled bonds are reinvested into the APF through further rounds of bond purchases in the secondary market, leaving the total amount of bonds held constant based on the permitted fund limit. That's how the APF works and how the Bank of England operates its government bond purchase programme. It was introduced in 2009 to tackle the financial crisis, and it has been an ever-present and ever-active component of monetary policy ever since. When you hear QE or quantitative easing, this is what it is referring to. Congratulations, you now know more about it than almost everyone on the planet. In one of the upcoming episodes, I'll provide the final piece of the puzzle by discussing reserve ratios. In this episode and the previous one, I've spoken of central bank reserves and how they can be used to provide banks and lenders with additional lending capacity. Reserve ratio requirements are how they're able to multiply that money many times over to create loans that far exceed the amount of reserves the banks and lenders hold. But that's it for this episode. I'm Mike, and you've been watching Mikeonomics.